hears that I really enjoy where we live, and I really enjoy our the landlord.
She should factor your consistency into her pricing algorithm.
We've never been. Yes, exactly.
Excellent.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Clearly, the banking system is telling us that there's some kind of issue here. And I would say, Lisa, that money has been shut down.
The banking system, for the first time, really is dealing with negative deposit growth year over year.
We don't see this as a systemic crisis, nothing compared to 08, 09, or 1990.
I cannot believe that what's happening in the banking sector will not give the Fed pause in this market.
This is almost like the opposite of the global financial crisis, and now the fears are way out there when the banks are more resilient than they've been in a generation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, across this nation, around the world this morning. There is financial crisis. The President of the United States will speak in the 9 o'clock hour. John, what are we going to hear from President Biden?
Well, let's deal with the politics first, Tom. I think this administration is probably very nervous about this being characterized as a bailout. That politically won't play well. So they're going to go through things piece by piece and really point out that in the European phrasing of this, Tom, we call this a bail-in. Right. Equities and debt shareholders, they don't get anything. They get bailed into the whole process. No bailout for them. But ultimately, there is a lifeline here for Wall Street banks, and that lifeline has been provided, TK, from the Federal Reserve with that new lending facility, allowing them to place securities that are deeply, deeply underwater.
Right, right.
Post that collateral at par at the Federal Reserve, and that's a big development yesterday. And
the news moving is, John, I don't think you saw this as you worked on that question here. Red and green on the screen. Market's quite volatile. We've told you about the bond market. Moments ago, the rework here of the Silicon Valley Bank, the gentleman from the Fannie Mae coming in to begin to run that shop here, all moving in real time before the president. And John, to me, what this shows is the immediate urgency to figure out where the haircut's going to be on troubled banks, troubled bonds, and let's work this out now.
In the meantime, this market is screaming, "Dear Jay, you're done. You're done." Yeah. And it's screaming that this morning. Now, I have no idea if that's going to be ultimately where we end up at the next meeting of the Federal Reserve or later this year. But to see the 2-year down another 41 basis points, pricing out rate hikes in the back end of the year, pricing in more rate cuts, Tom. That's the argument right now. And if you're just tuning in, there's two very clear camps. One is the market is right, they're done. Two, what was announced yesterday will allow this Federal Reserve to say, look, we've got the tools to deal with failed banks and we can carry on focusing on inflation. Right. Now, what would be helpful is some Fed speak for once. Unfortunately, you're not going to get it. It's the quiet period for the Federal Reserve.
Key headline I mentioned an hour ago. Did I see this coming? To be honest, no. Brent crude, that global oil price, Lisa, under $80 a barrel. It's not down 10,000, but it signals the linkage here of all we're talking about into the global GDP and American GDP call.
To put these two things together, the idea of fewer rate hikes or even no more rate hikes and actually the Fed cutting rates is viewed as a negative because it comes on the heels of potential true distress. And I think that one of the key questions is how much do lending standards, to Michael Shaul's point, how much do lending standards tighten really meaningfully over the next couple of months in a way that hadn't been anticipated, that really accelerates some of the disinflationary process without the Fed having to raise rates further? And if it doesn't, what does that mean in terms of the dual mandate for a Federal Reserve that's looking at inflation that's running at the hottest pace still, going back 40 years?
John, what would Powell say? The president speaks at 9. The Secretary of Treasury comes out at 12, maybe 3 p.m.-ish. The chairman comes out and has to make, comments from a written statement, and he says them into a super restrictive America. That's where we've turned since Friday.
I don't know what he'd say, but I know what my question would be. Is policy now in conflict for the Federal Reserve? Do you have to deal with financial stability risk and elevated inflation simultaneously at the same time? How difficult is that? Do you have the tools to deal with one? At the same time, you have the tools to deal with the other. Right. Now, the governor of the Bank of England had some experience of this back in September. Very unique situation, different to this, I get all that. But they really wanted to communicate that we have the tools to deal with one and the tools to deal with another. I think Lisa's right. Just to lean on what we heard in the last hour from Michael Shaul, Michael talked about lending standards are going to tighten up in the United States of America. Banks are going to have to be more conservative. Why? Because CEOs, shareholders, debt holders got wiped in those bank failures. Yes, depositors are made whole. We understand that based on the developments of yesterday, Tom. But if you're running one of these banks, all of a sudden you've got to run your institution maybe a little bit more tightly than you were previously.
We had 3 breaking headlines here. Let's get out front of the next headline here. Moments ago, Lisa, on lower lows, Credit Suisse breaks down. Not quite to lows for the day, not quite to record lows, but the stock acting terribly.
We haven't necessarily seen the end, at least in the pricing, not only of Credit Suisse, but other banks, which raises a question. Why not? If this is really just a crisis of confidence, why was the move by U.S. authorities over the weekend not enough to stave some of the concern about perhaps more bank runs or perhaps greater weakness in some of the weaker financial institutions?
Let's get to it right now. John, do we need to do any data? Is there any data there screaming?
Tom, to be honest with you, we'd be here all day because I'd carry on speaking, and no one wants that.
Subhadra just emailed me, no, tell John not to do a data check. Subhadra Rajappa joins us right now on this historic day with Societe Generale. Subhadra, I want to speak, I think, towards what the president will comment on here. What can we glean from the fixed income markets that can help politicians gauge the moment? What should they be watching in fixed income?
Well, they're not watching anything specifically in the fixed income market per se, but what I think we should be encouraged by is the fact that financial conditions are still relatively easy. You're not seeing a meltdown in the equity market. You're not really seeing broader risks of a contagion in all markets. This seems to be very localized, if you will. In the bond market, you're seeing a pretty dramatic decline in yields as the market starts to price out rate hikes for this year. So for the most part, at least thus far, it seems to be localized to the price action, I should say, in the bond market, and we're not really seeing a big risk of a contagion.
Two things, Subhadra. One, you called for lower yields. You're getting them in a major way this morning. We'll come back on that call in just a moment. The second thing, there's 2 clear camps emerging. We've been discussing them in the last hour or so. One is that the market is right. This Federal Reserve is done. The second camp is ultimately the Fed has shown it has the tools to deal with failed banks and can focus on tackling inflation. Which camp are you in?
It's going to have to be the latter. I think it's very soon to make a call on the Fed being done. Like you guys have been discussing over the last couple of minutes, if you look at inflation, it's running very hot. You have a very strong labor market. And most importantly, financial conditions are easy. The financial stability risks seem to be somewhat ring-fenced and isolated with a couple of banks. The question really becomes one of, does the Fed have all the tools it needs to be able to contain this problem? And again, you guys did a good job of outlining what happened in the UK. I think the parallels there are very prescient for this particular moment, where the Fed can kind of thread the needle on two separate issues and continue to raise rates, at the March meeting and even beyond, if we can kind of deal with the problem at hand.
Subhadra, I want to just talk about the mechanics of the bond market at a time when you're seeing a 50 basis point move in the 2-year, at a time when so many people had parked their cash in this debt. How much is this kind of creating fragilities in and of itself, that there is such incredible volatility in the benchmark basic instruments that people use as tools of safety?
So if it is a tool of safety, you want to be long the bond, and we've been kind of talking about that pretty much since the beginning of the year, even when yields started to rise, is that this is typically the sort of price action you tend to see in the bond market towards the end of the cycle, where the market gets a little bit skittish on the potential turn in policy. So especially given the fact that yields have risen so dramatically, our view has consistently been that the risk to yields are asymmetrically skewed towards the downside. And that's exactly what you're seeing in the price action. Yes, the moves look very dramatic, and that's because the absolute level of the 2-year was at above 5%, just a week ago. So a lot of that repricing is going to happen in the very front end. So that doesn't surprise me at all. But what we have to see going forward is not really read too much into the price action here. This could be partly driven by position unwinds, given the fact that the market was extraordinarily short heading into the March FOMC meeting. But I think cooler heads will prevail when we have more information on how this route is going to play out, broadly speaking.
How are you going to play this, Subhadra? Are you going to lean into the long end? Are you going to basically cash in on some of the short positions that you've had, the short end of the curve?
We really didn't have any shorts. I think we've been kind of leaning long in bonds for a good portion of this year, given the fact that it's really hard to call the pivot on policy. So it's kind of especially given the fact that you get such good returns in bonds. Our bias was perhaps to play from the long end, because yes, we might lose the last 25 basis points of rate hikes, or not be able to know where the terminal Fed funds rate is. But broadly speaking, the market's going to look towards a trajectory of lower yields over the next year or two. So in that sort of context, I think that long play made sense. That said, we've moved quite significantly lower here. So I think we probably take a pause, look at how things evolve. I wouldn't be surprised if we see another leg higher in yields if we start to price in more hikes as the time progresses, given the fact that we're not anywhere near achieving the goal on inflation.
Subhadra, your bond call is looking pretty good this morning, and over the last couple of days, that's for sure. Subhadra Jaffer there of SocGen. Subhadra, thank you. Tracy Alloway of Bloomberg out on Twitter just moments ago. She said this, and I'm looking forward to the Odd Lots podcast around this story with Joe Weisenthal. I'm sure they'll put a few out over the next couple of weeks.
20.
A bank with subpar risk management and flaky depositors just changed the US financial system forever. Tom, there's many dimensions to this story, but that take is an important one.
It's an important one because Tracy has legitimate San Francisco tech cred in her travels. She spent a lot of time out there. So if I say flaky, I sound like an idiot. She says flaky, it's valid.
When I quote her, is that okay?
No, no, I'm serious.
Flaky works.
Tracy is hardwired to that. John, Credit Suisse moments ago, breaking down, we are moments away from testing true new lows. You begin to wonder, a one handle in Swiss francs and Credit Suisse, we're not there yet.
It came close earlier, 211. Right now, 216. Just off session lows, we're down a little more than 13%. Futures on the S&P session lows right now, we're down 0.6%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Bloomberg has learned Russian President Vladimir Putin plans to meet top business leaders in the Kremlin this week for the first time since he launched the invasion of Ukraine. The March 16th gathering with the top members of the Russian Union of Industrialists and Entrepreneurs comes as a government, which is struggling to cover rising spending as the war enters its second year, steps up pressure on companies to pay more in taxes. The Wall Street Journal reporting Chinese leader Xi Jinping plans to speak with Ukrainian President Volodymyr Zelensky for the first time since the start of the Ukraine war. Bloomberg has learned the visit will likely come after Xi meets with Russian President Vladimir Putin as soon as next week. And Xi Jinping has started an unprecedented third term as China's president, with fresh vows to ensure stability and strengthen party leadership. In a speech closing out the annual National People's Congress, he vowed to oppose foreign interference in Taiwan, a veiled reference to increasing American support for the government in Taipei. U.S. authorities took extraordinary measures to shore up confidence in the financial system after the collapse of Silicon Valley Bank, introducing a new backstop for banks that Federal Reserve officials say is big enough to protect the entire nation's deposits. The Treasury Department, Federal Reserve, and Federal Deposit Insurance Corporation followed a frantic weekend that saw the surprise closure of New York's Signature Bank, along with mounting concerns about spillover effects to other regional lenders and the wider economy. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
The city banks or decent banks are in a very different place than the regional community banks. I think the market will continue to suss that out. But you go back to SVB, it was an outlier in almost every metric that one could look at. So to me, it's far from systemic. I think this is just a snap reaction more than anything else.
Greg Peters of PGIM there. Well, for the regulator, it was systemic. They used the systemic exception and came out and said, we're going to make all depositors whole. So that tells you a lot about how they viewed the situation. From New York City this morning, good morning. A lot of you have written in. Thank you for that, including Bill Lee of the Milken Institute. He said this. He said, regulatory support from the FDIC, the Federal Reserve, are the appropriate ways to deal with bank execs' risk management failures and liquidity shortfalls. Monetary objectives, Bill says, should not be compromised with non-systemic bank failures. We keep using this phrase, non-systemic. Well, the way they treated it yesterday, Lisa, there was a fear that it might be.
Well, there was a fear that it might be, and they took actions, and you're still seeing the fallout in shares, which raises a question of, A, was it systemic? B, was it enough? And C, what does this mean longer term, especially at a time, to Billy's point, where you do still have an inflation problem and you still have to have a policy to combat that?
I would go OBE. They're going to become overcome by events, and that's why the market's open now, and it's of good value. I've got Brent crude going down to new lows, $78.85. On global oil, John, $72.77 on West Texas Intermediate. We begin to think about a 60 handle there. We can go on and on, but the markets are reacting, and that changes the political dialogue that Bill Lee knows so well.
In a major way. Lisa mentioned some of those single names. First Republic, pick one, it's down 64% in the pre-market. Go to Europe, to Switzerland, pick another. The beleaguered Credit Suisse is down by almost 13% at 217 and just about holding on to a 2 handle. And I go to the bond market too, TK, here. This move at the front end of the curve, can't take my eyes off it. We're down more than 40 basis points on the 2-year. This market at the moment, not my view, just this market at the moment is screaming to the Fed, we think you're done.
Key idea, Bob, the oil just breaks through to new low. To me, John, I agree. The 2-year yield breaking down below 0.50 would be a new retest.
This just coming out from Andrew Hollenhorst to Bill Lee's point. He thinks that markets are once again underpricing how high Fed policy rates will need to rise and how long they will stay there, and still reaffirms the potential for 5.5% to 5.75% terminal Fed funds rate at a time when right now the market has it priced at about a percentage point below that.
George Bush the Younger, 15 years ago, a September evening. Over the past few weeks, many Americans have felt anxiety about their finances and their future. I understand their worry and their frustration. Perhaps copy for the President of the United States here in 45 or so minutes. Joining us, our Bloomberg financial crisis correspondent in Washington, Anne-Marie Horton. Anne-Marie, just simply, you've been listening, reporting on this, listening to White House people. What is the zeitgeist at the White House as the president will speak to the nation?
Well, I think it's a massive lack of sleep at the White House this weekend. These individuals across the White House, the Treasury, FDIC, have been working over the weekend to put this plan in place. And the president is going to speak at 9 a.m., something, we weren't really expecting over the weekend. But then after last night's news, they've come out and said he's actually going to address the American people. I think Jonathan made a really good point earlier, which is that this administration wants to make sure to everyday Americans that this was not a bailout. These depositors, that even if you were below the threshold, these depositors all being insured, that statement said all money would be returned and you have access to it today. They want to make sure they know that is not taxpayer dollars. That's going to be one thing I think the president will want to emphasize. And I'll also want to talk about the fact that they had to move promptly because I guess that means they were concerned of potential risks further in the financial markets, and they wanted to protect everyday consumers. The other thing is you can expect, the president said in his statement, I am firmly committed to holding those responsible for this mess fully accountable and to continuing our efforts to strengthen oversight and regulation of larger banks who are not in this position again. That opens up a field of what Congress could potentially do following this chaos.
So this goes back to 2018. The Trump administration, the Republicans, there was a bill to unwind some of the regulation around smaller lenders, smaller banks, regionals. I believe there were 17 Democrats that voted alongside Republicans on that bill. Are we saying that they're going to push to unwind much of that in the coming months?
Well, there was 17 Democrats that voted alongside Republicans for that bill. Jonathan, you are correct. You have to look at who some of these individuals were. They were in states that Trump won, so politically this is something that they wanted to lean into because a lot of them were up for re-election. And then there was just a handful as well. There's a lot of bank lobbyists out in full force during this time, trying to get them to unwind some of this. Many of them, like one of the Dakota senators, Heidi Heitkamp, had come out and said they don't understand the rural regional issues we are facing. So the issue now is, will those Democrats, some that are still senators today that voted for this, like Senator Warner of Virginia, Senator Coons of Delaware, would they be on board of rolling back that deregulation? We already heard from Senator Elizabeth Warren. We've already heard from Senator Bernie Sanders. They are saying that 2018 law needs to be deregulated. But for Trump, he said this was a bipartisan issue because 17 of those Democrats signed up for it.
What's going to be the consequence for some of the management teams of banks that that do have to tap into the resources, that do struggle with some of the potential mark-to-market losses on portfolios that they did have control over?
I think what you're going to see in terms of consequences in Washington is that there will be hearings in Congress. I mean, that is almost without a doubt. There will be hearings certainly for SVB, certainly for Signature Bank. You could expect Congress to call these individuals, the C-suite of these companies, before the Hill and testify on what went wrong and try to draft how they can avoid this in the future.
MH, just pushing forward, the brilliant David Weston's going to stand aside. He's going to focus on Wall Street Week through the rest of this year. I'm looking forward to his coverage. You're going to step in with Joe Matthew to Balance of Power. I understand the time of that's going to move, so it's going to be at 5 p.m. Eastern time, a little bit later this afternoon. AMH, first show today. What a way to kick it off.
I mean it's a slow news day. It's a way they can ease into it.
It's almost like AMH engineered it. Anne-Marie, what are you focused on a little bit later?
I think today we have to focus on the conversation we just had right now. What is going to the response from Washington following this collapse of SVB, this swift and prompt decision from Treasury, the White House, and the FDIC, and what comes next, and how do we prevent this in the future?
Because it's a kickoff show here, have you efforted Chairman Powell? I mean, I think that would be a good conversation.
I made a few requests.
Chair Powell, the Treasury Secretary.
Seriously, do we hear from Yellen and Powell today, Anne-Marie?
No.
Well, we're first going to hear from the president, and I think he'll probably leave it there, maybe send out some deputies. I mean, we heard from Secretary Yellen over the weekend. She went on Face the Nation.
Yeah.
I doubt we are going to hear from Chair Powell. Remember, he just had 2 hearings last week, another kind of awkward moment. Remember, all those Republicans were telling him, warning him to ease up on the capital requirements for banks just last week.
Can you imagine if we redid the hearings again this week, just how different they'd be? They'd be so different, Tom.
My recollection of 08, long ago and far away, it seems like it was yesterday, is it was the same ugliness there, where you looked at some authority and what they said 3 days before was embarrassing.
Just changes. Anne-Marie, looking forward to the show a little bit later with Joe Matthew, 5 p.m. Eastern time. That's Balance of Power on TV and radio. In the next hour on Bloomberg TV, massive lineup, loads of people offering their views on the situation. Peter Schiff of Academy, Michael Contopoulos of Richard Bernstein Advisors, Amy Will Silverman of RBC, Ken Leon of CFRA. I believe Julian Emmanuel is going to pop on the phone as well from Evercore to give his view on a situation, Tom, with this market making a big move in bonds, making a huge move.
Talk about Julian Emmanuel, and that's something we have not talked about. This crisis, if we get the Evercore ISI view on disinflation, forget about the crisis, but if we get a disinflation vector that begins to move towards 5-ish, 4-ish, 3-ish, how does that change everything we've talked about this morning?
We've barely discussed the data this morning. It's not just CPI tomorrow. It's retail sales on Wednesday. Last week, I think I started the week, we had all these conversations about 50, and then Chairman Powell basically talked about increasing the pace and maybe open the door to it. We sat here, I said it repeatedly. Every conversation we have is at the mercy of Friday's data and Tuesday's data, and then all of a sudden...
It's not relevant at all, and we don't care.
It's so much more than that, Lisa.
Well, the long and variable lags, it's suddenly becoming relevant again. Are we there in terms of the long and variable lags? And that seems to be the implication of markets.
Mike Wilson of Morgan Stanley says those long and variable lags have arrived, Tom. They're here right now.
35-year chart, almost back to Volcker. The log slope of Fed action is unprecedented, how quickly they moved.
Equity futures negative 0.4% from New York City. This is Bloomberg Surveillance.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg. We welcome all of you on radio and television to An American Crisis. The president will address the nation in the 9 o'clock hour. Help me out here if you can, Amy. We're talking 900-915. Do we know when the president will talk?
It's right at 9
in the 9 o'clock hour, as he is wont to do, and maybe we'll hear from Secretary Yellen as well. Right now, we're going to hear on the difference between now and the chaos of yesterday, which is the markets are open. So Lisa Bramlett and I are going to address that. I'm going to see a little bit of red on the tape. There's a new lack of a bid on the tape, and Lisa, you've noticed the 2-year yield is out to a shocking level.
Well, we've been talking about this all morning, and the move just simply has accelerated. Do we get a sub 4% 2-year yield today? Right now, we're looking at 4.05% on that 2-year yield. The move has been dramatic. When you take a look at Fed funds expectations, now we are pricing in a peak Fed funds rate of 4.7%, which then gets cut, and we're pricing in about 50 basis points of rate cuts, Tom, by the end of the year. Is the inflationary picture disinflationary enough to justify a view in markets that seems to discount any potential for the Fed to move?
I would suggest off your stock movers of the last hour, the idea of following FRC, First Republic Bank of California, seems to be the single American stock to follow this morning.
Yeah, and there are a number of others as well as people try to parse out which are the most vulnerable, even though we had a response that supposedly backstops depositors above $250,000.
What you need to know on technology is people get chosen. There was a woman out of Minnesota who was exceptionally astute in operational research at Stanford, and she was anointed, I remember the day as clear as I can, Marissa Hu, was anointed as the leader of Yahoo. Many would say she at least stabilized the company and moved it along in its eventual pain. The gentleman that found her was Michael J. Wolff. He's co-founder and CEO of Activate, is a unique voice for technology in this country. He has worked with MTV, but far more with consulting, with McKinsey and all. He is a voice that it's Michael Wolff on line 2. They answer the phone. What did you do this weekend? Were you glued to the phone this weekend?
Well, it was a dark weekend for startups and for venture capital firms. And either on Twitter, either on message boards, and really blowing up my texts over the weekend, because where people were afraid, startups and VCs were concerned that they wouldn't make payroll this coming week.
Right.
And they were concerned that come Monday, they'd have to start letting people go.
I want you to address the behavioral construct that was beautifully described by the Wall Street Journal, anecdote after anecdote, and I'm not going to mince words, Michael. It was fancy tech guys with fancy educations on fancy Gulf streams from Big Sky in Montana, flying back quickly to Northern California to salvage the mess. That is the image that America has of your world. Is it accurate?
Well, what's ironic is that in a lot of ways, the venture capitalists started that. And so it's the immediacy of social media. So starting on Wednesday, they already started advising their startups to take money out. And by Thursday, over $40 billion had already left Silicon Valley Bank.
Right.
And so in a lot of ways, this was self-imposed. And what's different about this versus 2008 was at that time, you had Twitter that had 200,000 daily users. Today, all of the communication is happening through social media. And so it's not surprising you had a run on the bank.
And what was so important in the quality threads this week, and the people that weren't hysterical, was Brad Setzer, wonderful at Harvard and Oxford. And at the end of his thread, Lisa, he was scathing about the lack of humility among tech types.
Gary Gensler out with this statement from the SEC that they are investigating and bring enforcement actions if we find violations of the federal securities laws. This raises questions of what potential conflicts some of these individuals had. Was that one of the discussions that people were having over the weekend?
No, the main thing was this concern about what this meant for startups themselves, and this concern overall for people outside the technology business about what would this do to the innovation that's been taking place. I mean, these were not big companies. These were companies, thousands of small companies who've, yes, taken in venture capital money, but there's concern that this would shut down innovation, that VCs would not be able to finance companies come this week or these coming months.
Michael Showell was on earlier, and he was saying that regardless of what happens and what the Fed is trying to do in the Treasury Department to offset some of the concerns about a failure to be able to withdraw with deposits, that lending conditions would tighten materially, and that some of these smaller companies would face much higher standards to borrow and much higher rates. Is that in the conversations that you're having with some of these startups?
Absolutely. I think they're worried about what happens, even though the Fed is going to backstop the bank and their funds are going to be available. I think their concern is, will this have a chilling effect on venture capital funding, and will this have a chilling effect on the places where they can borrow money? And in a lot of cases, though, many of them are expecting to keep their money at Silicon Valley Bank. Over the weekend, a group of venture capitalists, Kleiner Perkins and others, and General Catalyst, they put out a statement that said no matter what happens, that they'll back Silicon Valley Bank. Now, there's also, if you look at some of the anecdotes, companies weren't even set up to take money into other places. Some of the founders were putting money into their personal accounts as they were able to transfer it out.
Is there a discussion about some of these venture capital firms helping some of their portfolio companies to actually meet payroll, to deal with some of their concerns on their imminent funding requirements?
Right. They're really, based on the conversations I was involved in, there really weren't, that was not an option on the table. I think that everybody was looking at this, and in fact, they were concerned about the laws in California in terms of what happens with missing payroll.
Michael Wolff, one of the sane voices this weekend, he was cryptic, but nevertheless sane, was a guy named Dan Loeb. There were others that were a little more hysterical, all caps in that, mouthing off in a time of true financial crisis. How do we get a behavior change in your world that affects a humility towards the entirety of America away from hyper-educated finance and technology elite?
Yeah, I think that what's happening, though, is the world is moving away. The innovation world is already moving away from Silicon Valley. It used to be you started a company, you could only be located one place, and that was the Bay Area.
Yeah, Steve Case has led on that. Let's be clear. The guy from AOL, Steve Case, has really led on that.
Absolutely. But when we move into new technologies like generative AI and self-driving cars and even the metaverse, it's in other places. And I think that Silicon Valley mafia will change.
Yeah, but I didn't hear Dan Loeb this weekend talking about the metaverse, and most of the people watching the show are going, Michael, what the hell is it? We won't know for 5 years. How do we reconnect Massachusetts Institute of Technology, Stanford, Caltech, and other elite Georgia Tech, Purdue, that's my pick in the NCAA. How do we connect technology engineering back with an America where the stereotype is they're flat on their back?
Right. I think that some of it's going to come down to innovation hubs. So Boston, in a lot of ways, and Cambridge, those are going to be places, and other places around Austin and others, where you've got people, and it's also opening up the world. I mean, a lot of these tech jobs have gone away. Those people are all going to find work, but they're not going to necessarily find work in Silicon Valley. They're going to find it in other companies, in mainstream businesses.
We've been talking about the potential fallout and the interconnectedness of markets that previously had been somewhat separate. And I wonder about stablecoins, for example, the sort of crypto asset that is pegged to assets that, for example, I'm thinking of the USD coin that had a lot of its assets parked at the Silicon Valley Bank, and suddenly it broke the buck, right? It went beyond $1, which was sort of the backing of its assets. I mean, how do you view that in terms of casting a real pall that has a permanence to it over asset classes that previously were heralded as the winners of the crypto winter?
Yeah, I mean, there, by the way, is the real arrogance, which is this idea that this wouldn't have happened if we had decentralized finance and blockchain. Yes, USD coin, it's supposed to be, it's a stable coin. It's supposed to always be stable at $1. It dropped down to 87 cents over the weekend. And USD had $3 billion on deposit.
Right.
So it is going to have a chilling effect on crypto. It is going to make people wonder, is this a viable place? Is it safe?
John from England emails in. John says, can you ask him if it was a bailout? Was this a bailout for younger Michael Wolff Turks from another time and place?
Well, I mean, this is very different. It's a bailout, but it's very different than 2000.
Agreed.
2008.
Okay, fine. But was it a bailout?
No, I think this was about liquidity. It wasn't this was not a bank that made risky investments in mortgage-backed securities. This is a bank that had a liquidity problem. They made bad mistakes in terms of their investments, and ultimately, a lot of that money will come back.
If you see, I don't mean to interrupt, but we're running out of time. This is too important. If you were asked to serve on the board of the new SVB bridge, what would be your advice?
I think that you better be an expert in finance, and you better have really understand the kinds of credit risk officers and other people that are in place.
Michael, we got to go because the news is just rip-roaring here as we're 30 minutes away from the President of the United States. Michael, on short notice, thank you for coming in today.
Pleasure.
Michael Wolff is
Quite
with
a day.
Activate, which barely describes his history with McKinsey, Yahoo, and others. Lisa, I was watching this as you were talking to Michael, and you know, the phrase we use on a normal day is there's no bid on the screen, except it's so complex in this crisis.
Or there's a rip-roaring bid at the front end of the yield curve because everybody just wants to pile into short end.
7 basis points
What you're
as
looking
Michael started
at
talking.
sub 4% two-year Treasury yields, the lowest levels that we saw going back to October 4th. 3.99% has come back a little bit, back around 4% even. I'm looking at this and wondering, what is the bet? The bet is no more rate hikes and rate cuts by the end of the year at a time when inflation still is rip-roaring. But as we keep hearing, conditions are tightening. Lending conditions are tightening. Is it enough, though, Tom? And this is really going to be the key question. Is it enough to curtail inflation that's running at the fastest pace in 40 years if the Fed doesn't hike anymore and even starts cutting rates by the end of this year?
We're not going to be inflammatory about it in terms of naming individual names and guessing what they're going to be doing in the next hour or so, but certainly it's very fragile into the discussion that the president will give. What do you expect to see from the president? I mean, it's got to be prepared marks. Does he come in and do one of those quick stand-ups, walk-off thing?
It's going to be, this is not a bailout, this is not a bailout, this is not a bailout, thanks, see ya. I mean, this is going to be trying to basically say, look, this is going to be an issue where they're going to say, we did what we had to do to make sure that these, innovative companies could meet payroll. We're going to take the actions that we need to support our banking system, but it's not a bailout, and we continue to expect combating inflation. Thank you, no questions.
On radio and television, please stay with us as we look to this. We looked at technology in this half hour. Michael Wolff with us. And I'm thrilled to tell you, and no, we're not going to talk basketball. Joining us, a gentleman from Bain Capital and a senior advisor, Steve Pagliuca. Last time we talked as a sport in this crisis, we will speak to him of the shadows of the private markets. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Norway, NATO forces are gathered for joint drills as a defense alliance, along with Russia, China, and others, compete for greater control of the Arctic. Estimates suggest the region holds around 1/4 of the globe's oil and natural gas resources. Meanwhile, Ukraine's interior minister says Russian missiles and artillery have destroyed more than 152,000 residential buildings since the start of the invasion. In his first public comments since taking office, Premier Li Qiang says China will protect the rights of entrepreneurs and continue to support private businesses. He also downplayed the importance of Beijing's modest economic growth target of around 5%, saying citizens are more focused on issues that affect their daily lives rather than the pace of the gross domestic product. U.S., Australia, and U.K. leaders will announce plans for a new fleet of nuclear-powered submarines as they deepen the AUKUS defense partnership aimed at countering China in the Pacific. Upgrading Australia's aging subfleet is a linchpin of that effort. President Biden will meet in San Diego today with UK Prime Minister Rishi Sunak and Australian Prime Minister Anthony Albanese to unveil plans to develop the new submarine. And a film made for less than $20 million was the big winner at the Oscars, picking up Best Picture and 6 other trophies. Everything, Everywhere, All at Once by independent studio A24 won out over some of the highest grossing pictures in Hollywood history. Avatar: The Way of Water and Top Gun: Maverick, which between them have taken close to $4 billion at the box office, scored just 1 Oscar apiece. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
I don't think this is likely to be a broadly systemic problem, but it certainly is going to have very substantial consequences for Silicon Valley, for the economy of the whole venture sector, which has been dynamic, unless the government is able to assure that this situation is worked through.
In the defense of the former Secretary of Treasury, Lawrence Summers, there on Wall Street Week, that was taped a little bit prior to the festivities of the weekend. Like a lot of other people, he is monitoring, I'm sure, the moment we're in tick by tick. We're going to get to a very important voice here in a moment, but Lisa, moments ago, the VIX over 30 is a significant sign for equity participants.
The VIX, not just measuring volatility in stocks, but also in bonds. The MOVE index hitting its highest level going back to early December as people expect this volatility in bond yields to continue and potentially accelerate in the weeks to come.
Some of it is a grind. Looking to Switzerland and Zurich, Credit Suisse and Swiss francs is grinding out to new weakness. We're not quite through to the record lows seen early this morning. We see it in some of the selected stocks in finance in America as well. And I'd also point within the bond market the dynamic of a real yield in 18 basis points for global Wall Street, 1.22 on the real yield is a shock. It is a highly restrictive environment. Moments ago, the Bloomberg Financial Conditions Index showing a restriction of negative 0.80. That may be Greek to you, but to Wall Street, that is a sign of a tighter economy, a tighter finance. That is something familiar in times of crisis. To Stephen Pagliuca, joining us now, Senior Advisor at Bain Capital. The last time we spoke, I believe it was of a basketball team in Boston. We will not do that today, and we will speak of this crisis. Steve, you are a venerable advisor to all of technology. Give us one vignette of a conversation this weekend.
Oh, many conversations. All the technology firms and companies and startups were basically shaken by this event because probably half of them had money with the bank, and so there was a mad scramble on Wednesday, Thursday, Friday, which basically started the contagion and ended up with the bank in liquidation. So the conversations were, how do we make payroll? How do we protect our capital that we had with what was seemingly a safe bank?
I should point out also, folks are beginning to see images of the president's speech being set up here, a podium and the flags of the White House. We'll look for that in the 9 o'clock hour. Steve Pagliuca, I want to talk about a new humility. The hallmark of people like Steve Pagliuca, a guy that owns a football team in England, and I think it's called the Red Sox in Boston. You guys had a built-in humility. Many would say that drifted away in the boom here and in the Biden stimulus and the massive cash move into technology. How does the industry get back a new humility in crisis?
Well, unfortunately, the industry's gone through this several times before. As you know, you were around in kind of the tech crash in '99, which was driven by overexuberance and values in internet companies. And this one has been a little bit similar, driven by Web3, crypto, Bitcoin, all sorts of blockchain, all sorts of exuberance, and prices have kind of come down. Venture investment has slowed. When there's obviously too much of a supply of anything, you get a counter reaction, and that's what's happened here, and that contributed to the downfall of a bank that specialized in that area.
We were just talking with Michael J. Wolf, and we were speaking earlier with Michael Shaul, talking about tighter lending conditions going forward for some of these smaller companies, the venture capital world, the private equity world. Are you seeing that among some of your portfolio companies? Are you seeing the likelihood and the expectation of it being more difficult to borrow?
Yes, it certainly will not be the easy money. That doesn't include venture capital. That includes the entire corporate world. Interest rates are up. Banks are concerned about their spread and yields. So you're going to see a tightening, and we have seen that tightening as we move from a quantitative easing period where there was easy and cheap money. We're moving back to, I would say, the new normal right now.
So last time we spoke, Steve, you talked about a golden era for credit, for private credit, I should say, and how this really seemed like a very fruitful area, not only for the borrowers, but also for the lenders. Does this change your view at all at a time when Michael Shaul was saying that potentially we could see more shoes to drop within the private asset markets?
It does not change my view. I think actually private credit will continue to grow dramatically. The difference of private credit and bank credit is private credit are sophisticated investors that put money into funds, and not unlike equity investors. And so, if a private credit company loses value, it only affects those certain investors. It doesn't have a systemic effect on an economy. And there are many companies that have viable loans, and they'll get those loans through private credit as the bank market tightens up. So I'm still bullish on private credit.
What about the equity side of things in the private markets?
Again, we've come off record high equity amounts and injections in venture capital, unprecedented highs, and now we're back to kind of a new normal where supply will meet demand. The unprecedented money going in raised all those valuations of those startup companies, I think, to unsustainable levels. I've been saying that for a couple of years, and now they've kind of come back down. So we'll get back down to a baseline level with more reasonable valuations. I applaud the government for making this move and ensuring these deposits, because this would have affected many good small companies, and so this was the move that needed to be made on a classic bank run, where the bank actually has a lot of assets. They were just written down from an accounting basis, and so I think really the right thing to do to kind of save the tech economy.
Steve, very quickly here, we've got to go because of moving markets, but Steve Pagliuca, I'm fascinated at what the new internal rate of return looks like and the new length of a private agreement. Do you extend out and lower the internal rate of return, or can you do better than that coming out of crisis?
You know, if you look at the track record of private equity and certainly Bain Capital in the last 34 years, we've maintained about the same level of returns in the kind of the 18 to 20% level for all those periods through crisis, through non-crisis, and had very good returns for investors. This is all an equation, and when interest rates go up, as you've seen, values in companies go down, but there'll still be companies that need capital, that need to grow, and private equity has done very well in driving those companies forward, and that will continue to be so. So returns should be basically the same.
Steve, thank you so much. Steve Pagliuca with us, Bain Capital here.
Thanks, Tom.
Giving us
really
perspective. What a great hour, Lisa, talking with Michael Wolff and Steve Pagliuca, trying to get straight talk from venerable people on what's got to be a changed industry coming out of this.
What's so difficult right now is the psychological impact versus fundamentals, and that fundamentals are being shaken by a psychological response. I mean, the idea that pretty much everyone said this wasn't a systemic event when we heard about what was going on Thursday, Friday, and now suddenly it is systemic and it's affecting other banks. You're seeing Schwab come out and say it has significant liquidity, don't worry, its shares were down significantly, trying to shore up confidence. How do you parse this out into some sort of longer-term macro call on inflation?
Well, you don't, but the answer is longer term in terms of trust and confidence is trying to get to 4 p.m. this afternoon. And frankly, with Bitcoin trading 24/7 here, Bitcoin pulling back a little bit from the enthusiasms of 2 hours ago, maybe that's even more sensitive with all. I do want to point out Bloomberg Technology, Caroline Hyde and Edward Ludlow will be a valuable point of resource here in the coming days. Can't say enough about that. Look for that on Bloomberg television. Futures negative 51, Dow futures negative 391. I'm sorry, Lisa, there's no bid. And Credit Suisse moments ago breaking down right on the cusp of new lows, 2.14 Swiss francs.
People are looking for what will be the next weakest link in the banking sector to go, even with some of the plans to try to stave off some of the distress. This, to me, is the big question, right? If this isn't systemic, then does this change the scenario with respect to inflation, with respect to rate hiking at a time when you're seeing the market price out further rate hikes and price in rate cuts of about 50 basis points by the end of this year?
I'd like to sell forward to tomorrow and then on to retail sales. Inflation tomorrow. When's retail sales? Wednesday or Thursday? I don't even know.
I believe it's Friday. I will check that
Okay,
right now.
Friday. I was wrong. I was wrong twice there. So they're typically with Bramall. I'm not wrong once.
No, you were right. I was wrong.
Okay.
So carry on. It's Wednesday.
Okay, well, it was a group wrong. But what we do see here, folks, is the economic data. Is it of importance to a nation in financial crisis? Coming up in the next hour, the President of the United States, with markets open, will address this banking crisis. Please stay with us on Bloomberg Radio and Bloomberg Television. Good morning.
Our studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
So most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell. And I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And he said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
What a start to the week. Live from New York City this morning. Good morning, good morning. Equities just about negative on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the U.S. backstopping bank deposits of failed banks. Goldman Sachs dropping its call for a rate hike this month as equities struggle to bounce and bond yields plunge. We begin with the big issue. Things begin to break. The United States, the president, preparing to address the nation after U.S. authorities took new measures to shore up confidence in the banking system. Late Sunday, the Treasury Department, the Federal Reserve and the FDIC said it will wind down two failed banks in a way that, quote, fully protects all depositors. The central bank also announcing a new bank term funding program that offers one-year loans to other banks in America under much easier terms. The Fed and Chair Powell now finds itself between a rock and a hard place. Goldman Sachs dropping its call for a rate hike this month as Chair Powell attempts to respond to financial stability risk and above-target inflation simultaneously. Here's the President of the United States.
Signature Bank. Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills. And their hardworking employees can breathe easier as well. Last week, when we learned of the problems of the banks, and the impact they could have on jobs of small businesses and banking system overall, I instructed my team to act quickly to protect these interests. They've done that. They've done that. On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. And fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable. In my administration, no one is above the law. And finally, we must reduce the risk of this happening again. During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses. Look, the bottom line is this. Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you, we will not stop at this. We'll do whatever is needed. On top of all this, let's also take a look at a moment to put the situation in a broader context. We've made strong economic progress in the past 2 years. We've created more than 12 million new jobs, more jobs in 2 years than any president has ever created in a single 4-year term. Unemployment is below 4% for 14 straight months. Take-home pay for workers is going up, especially for lower and middle-income workers. And we've seen record numbers of people apply to start new businesses, more than 10 million of them, more than 10 million applications over the last 2 years starting businesses. Now we need to keep this progress going. That's what swift action that my administration over the past few years is all about. Protecting depositors, protecting the banking system, protecting the economic gains we've made together for the American people. Thank you, God bless you, and may God protect our troops. See you in California.
Mr. President, what do you know right now about why this happened? And can you assure Americans that there won't be a ripple effect?
A brief address from the President of the United States there. 4 brief points from President Joe Biden. The effort here to protect customers with deposits, really trying to emphasize there that no taxpayer dollars will be put at risk, that they will look to make sure that those that are responsible will be made fully accountable and will not protect investors of these failed institutions. Your team coverage begins right now with AMH down in D.C. and Katie Lyons alongside Mike McKee here in New York. Anne-Marie, this is not a bailout, I think, is the communication effort from this administration this morning.
Oh, that's exactly what the president wanted to make clear before he wheels up, Jonathan, to California, that this is not going to be out of taxpayers' dollars when it comes to protecting those deposits at the bank, the Silicon Valley Bank this morning. The 4 points, all customers that had deposits, he wanted to rest assured. If you have deposits in these banks, if you are a small business, you need to make payroll, you will get your money back. 2, no losses will be borne by taxpayers. These will come from the FDIC, and of course, it's the fees that the banks pay into the FDIC. Management of these banks will be fired. Direct quote from the President of the United States. He's saying the FDIC is taking over these banks. Those executives will be gone. And then investors in the banks will not be protected. To your point earlier, this is more of a bail-in. The other thing the president said, Jonathan, and this is the big signal to Democrats and Republicans on the Hill, is he is calling for more regulation, and he also did make sure he had a moment to talk about Dodd-Frank and some of that rollback of that regulation we saw under the Trump administration in 2018.
Stronger regulations are coming. AMH, you and I talked about it a little bit earlier this morning. Pretty clear that that was going to be around the corner. It is. We'll talk about it a little bit later. Kelly Lyons, is it sufficient? Have they done enough?
It doesn't look like the market believes that this is enough, either that lending facility provided by the Federal Reserve or the fact that all the depositors in both Signature and Silicon Valley Bank will be made whole. The regional banks are not buying it this morning. Just take a look at the shares of First Republic, for example, in pre-market trading down 62%, and an ETF that tracks those regional banks is down 8.8%, and it's bleeding into the broader financials too. That broader financials select sector spider down 3% right now in pre-market trading. It does not seem like everyone is convinced that this is going to stem the risk of something systemic happening here. And certainly, given that investors are not going to be made whole in these banks, maybe no one wants to risk being left holding the bag, hence why you are seeing the selling pressure today. I would note, too, that this is bleeding into the broader economic and monetary policy thinking this morning as well. You see that reflected in the bond market, just an absolutely massive move happening in yields this morning. Right now, the 2-year Treasury yield down another 42 basis points on the day. We are now down more than 90 basis points over the course of the last 3 days. We have not seen a 3-day move like that since Black Monday all the way back in 1987. This is a massive repricing of what things breaking in the financial system ultimately is going to mean for the trajectory of the Fed's policy, John.
And day 3 of that move is not over just yet. Mike McKee, that tees us up nicely. The Fed's next move, we've got CPI tomorrow, retail sales on Wednesday. If the chairman could do that address all over again this morning, Mike, what would it sound like?
I'd probably sound the same with some of the things that the president said thrown in as well, because the Fed doesn't know what it's going to be like 10 days from now. Now, you go back a year and you look at what's happened and you can see where the problem came. That's the yield curve. The bottom is the day before they started their tightening process, and the white line is where we are now, even though that's come down some, as Kayleigh was mentioning. And the problem is, of course, that if you bought bonds at the blue line and you now own them at the white line and need to sell them as the banks do, you're losing money. And that's created the problem here. So what did the Fed do over the weekend? They created this bank lending program. So a bank that is forced to sell some of its assets can instead take them to the Fed and get a loan for their value at par. It's similar to the discount window, but they do get a year instead of 90 days to pay it back, and there's no haircut on the value. And the Fed also supported the FDIC's systemic exception to cover uninsured depositors. Now, the dirty little secret is uninsured depositors are almost always made whole in bank resolutions. Been a very long time since that hasn't happened. IndyMac, the last one in 2008. Where does it leave the Fed? Well, as I said, 10 days from now, they will be making a decision, not tomorrow, so they'll watch what happens with the banks, but you can see how market expectations have changed. Now we're basically pricing in about one more move, 25 basis points to about 5%, but not quite even that. And so we're going to have to see what happens, because we have CPI tomorrow. We have PPI on Wednesday, John. And if these banks make it through the next day or two, the whole narrative may change.
Mike McKee, thank you, sir. Kelly Lyons, Anne-Marie, the three of you staying close through the hour, no doubt. Equity futures right now down 0.75%. In a world where a bank can fail in something like 24 hours, 10 days is a long time. In the bond market right now, as Kelly pointed out, yields lower by more than 40 basis points on a 2-year, 418. Worth pointing out repeatedly that we were close to 5.1% in Wednesday's session just last week. So as Kelly mentioned, it's not even 3 full trading days, and we've seen a monster move in this market. Let's discuss it with CreditSights Zach Griffiths, RB Advisors Mike Contopoulos. Now, Mike, as you know, buddy, the Fed gets to decide when we start hiking interest rates. This market gets to decide when they're done. Has this market just decided they're done?
Well, I think that's clearly what the 2-year is telling you. You know, if we look at the move over the last several days, it's pretty dramatic. Obviously, the ultimate terminal rate has been priced quite a bit lower. And, you know, cuts have been brought forward a little bit. Pause has obviously been brought forward a little bit as well. And 25, you know, is certainly the go-to bet, if not nothing, let alone 50. And so, yeah, I mean, I think the bond market is telling you that we're much closer to the end than we were, 4 days ago. I don't know if I fully buy it, but that's certainly what the market's telling you today.
Well, that's the debate, isn't it? Goldman says they're done this month. They won't be hiking, and what happens after that, we don't know. But quite clearly, Zach, there are 2 very clear camps developing this morning. One is that the market's right, they're finished. The second is that the Fed over the weekend, together with US authorities, has shown they have the tools, the tools to address failed banks and can focus on tackling inflation. Andrew Hollenhorst of Citi in the last hour published and said this: a policy rate hike remains very likely next week. Recent bank failures were unlikely to be systemic before the Fed acted, and that possibility is even more remote after officials signaled even uninsured deposits would be protected. So, Zach, to put you on the spot, which one is it?
I'm inclined to agree with all that. I think 25 basis points is still very much on the table. We have CPI tomorrow. I think, if anything, the recent trends in inflation have been going the wrong way, or at least shown a pause in the disinflation that we've seen. So I think the Fed is still going to be beholden to the inflation and labor market data when it sets policy in 10 days from now, as they've already addressed the immediate concerns from a liquidity perspective dealing with these banks. And so I think for now, as long as CPI comes in close to in line with expectations, another hike is still on the table, as the labor market and inflation really aren't giving the Fed signs that it can pause just yet.
And so, Zach, what do you make of this move at the front end of the curve, not just in the US, but in Europe too, in Germany?
It's a huge move, and it's showing that market expectations have repriced significantly, and I think that makes sense, more so from a terminal rate perspective. I'm not so sure that the Fed or the ECB or other major central banks that still need to tighten policy to address inflation are done just yet, but it makes a lot of sense to us that we're not going anywhere near as high as the market had been priced for last week, as taking out those potential additional incremental hikes seems unlikely given the unexpected move and just all of the uncertainty that's in the market now.
Well, the last month has been dominated by a conversation about maybe this Fed going even further, that these long and variable lags might be a whole lot longer. Mike Wilson of Morgan Stanley, publishing earlier this morning, he said those long and variable lags are here right now. He said the past week witnessed the sudden collapse of SVB. The real story for equity markets is the impact of the Fed's actions over the past year. He goes on to say earnings growth expectations remain materially too high, and the markets are now likely to price that risk more quickly. That's the equity story. Michael, what does that mean for credit?
Well, you know how we've felt about credit, Jonathan, for the last several months, which is that, there's really very little upside. I think the last time Zach and I were on, actually we had a good debate about this. Credit markets are priced to perfection. They've widened out a little bit over the last several weeks, but we still think, listen, when you're in an environment where you're in an earnings recession, where equity volatility up until recently has been very, very low, which credit spreads tend to follow equity volatility, when you have leverage metrics, interest coverage metrics deteriorating, when you have an increase in downgrade risk. I mean, none of these things are good for the investment grade market, let alone the high yield market, where defaults are also picking up. And, I think investors are often confused by the fact that, maybe corporate credit is higher quality than it has been in the past. And I think, you could maybe make that argument, but that doesn't mean that names won't get downgraded and funding costs need to go up and spreads need to widen. That doesn't mean that volatility isn't going to go up and spreads are going to widen. And so I still think, particularly investment grade credit is one of the worst relative value propositions I have ever seen in my career, versus what you can create in the treasury market or in really, really high quality structured products. And I can give you, AAA CLOs paired with long-term treasuries and have virtually none of the credit risk of the investment grade market and all the yield and the upside of falling rates. And so to me, credit just makes no sense right here. And as a consequence, we almost have no credit exposure across our portfolios.
Zach, are you still taking the other side of that?
I think my response is a bit more nuanced than it was a month or two ago. I think that from a strategic perspective, we still think there's good value there. And I certainly take the point that the amount of spread pickup you're getting by owning IG versus treasuries is quite low historically. But we do think that there are still attractive opportunities. And when we think about how we want to position from here, we've been in the tactically cautious camp for about a month. I think that's going to remain prudent for at least the next couple of weeks as we let things shake out here. But we're not bailing on our strategic view of kind of overweight in credit, just given the strength of the U.S. economy behind this. And our bank analysts have been adamant that this is not a systemic issue in the banking system. And we think the Fed has moved to take care of the immediate concerns, and it remains to be seen kind of the second and third order impacts of this, but we're not changing our strategic views just yet.
So one tool they announced yesterday to address some of that was this new bank term funding program that offers one-year loans to other banks in this country at really, really favorable terms.
Capital Economics was straight out on it yesterday evening, after the news came out. They said the shift to accepting collateral at par rather than marking to market means the banks that have accumulated more than $600 billion in unrealized losses on their held-to-maturity Treasury and MBS securities portfolios should be able to ride out the storm. Zach, as you know, these securities, treasuries, whatever, they're deeply underwater. To be able to post that collateral at par, how transformational is that? How big is that announcement yesterday?
That's a huge move, and it really addresses the core of the issue that Silicon Valley had to realize in selling those securities that were hugely underwater. Now that banks have access to this facility over a year at par, it essentially wipes out the concern of having to actually realize these unrealized losses that are in these books. And so I think it's a huge move, and it really addresses the core of the issue that we have that we saw over the past couple of days, and addresses it quite well. So I think that that's really big for just how things are going to unfold over the next couple of days or the next couple of weeks, and kind of lets the Fed address monetary policy with the policy rate setting next week.
Mike, just to give you the final word, this word bailout is emotionally charged. Some people really fighting against its use, including, of course, the administration for obvious reasons. But this seems like one heck of a lifeline for poorly managed financial institutions in this country.
Yeah, it certainly is, Jonathan. And you know, listen, at the end of the day, you had 10 years of infinite liquidity, and you're pulling back on that liquidity. And we've talked for a long time about long duration assets suffering from that, whether it be technology and venture capital or crypto, or long-term bonds for a period of time. Now we think that's kind of the other side of that, is that the growth story will pick up on the long-term bond side. But up until recently, right, we were very, very underweight duration as well. And so listen, this is what happens when you have tighter financial policy and you have an inverted yield curve, and you have that on the back of 10 years of infinite liquidity and low rates. I don't know what the Fed or the government expected to happen, but this seems to make a ton of sense. And quite frankly, is a little bit refreshing that you're now potentially going to have a reallocation of capital from tech and innovation and unproductive assets to maybe actual real assets. And, listen, I think it certainly leaves us a bit uncomfortable with what the Fed is doing, and it effectively being a bailout, bail-in, I don't care what you want to call it.
Sure.
But it certainly is a ton of moral hazard. But listen, at the end of the day, this is exactly what we should be expecting. It's going to have consequences.
Well, let's see if it's sufficient. And if it's sufficient, why is First Republic down 63, 64% at the pre-market? Mike, Zach, to the both of you, fantastic to catch up with you. That move doesn't make sense if you think this move is sufficient by authorities in America. I want to get back to AMH down in Washington. Anne-Marie, we heard from the president about 20 minutes ago. This regulatory push, we can see where this is going, can't we?
Yeah, we certainly can. And Jonathan, already before the president came out and spoke, we heard from the likes of Senator Bernie Sanders, Senator Elizabeth Warren. These individuals have been talking and complaining about this deregulation that happened in 2018 since that bill was put to the floor. The issue this president's going to have is that obviously it's a divided Congress. You have the House being controlled by Republicans, which if you were watching the Powell testimonies last week, you have these individuals warning the Fed about the risks of having too much and too strong capital requirements on banks. So you're almost living in a parallel universe depending on which senator or congressman or woman you are speaking to. But going back to that 2018 deregulation we saw, this changed the oversight, this changed the threshold for small to medium-sized banks. 17 Republicans signed up for it. When former President Donald Trump signed that bill, he said this was a bipartisan effort, and he hopes to have more bipartisanship like that in Washington.
AMH, down in Washington, thank you. It's interesting you heard the president refer to the previous administration, but not those 17 Democrats that voted with the previous administration. We heard from the president just moments ago. Take a listen to what he had to say.
We must reduce the risk of this happening again. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again.
Got a fantastic guest lined up to talk about this. Henrietta Trays there of Vader Partners joins us right now. Henrietta, down in D.C., great to catch up with you. Let's just start here. What do you think's on the agenda now in Washington?
I have a terrible answer for you. The answer is that the House Republican Conference is going to leave for its issues conference, and they'll be out of D.C. for the entire week. So not a whole lot, to be really honest. And when they get back, I'm sure there will be hearings. The Senate will, of course, hold hearings and have continued briefings, particularly the California delegation. The House Democratic California delegation will continue to get briefings, but there will be no action out of D.C. this week in terms of legislation passing, certainly not what President Biden called for moments ago.
Henrietta, you heard from the president moments ago. He was very keen to point out that the previous administration had pulled back on some of the regulation around these small and medium-sized financial institutions in this country, regional banks, etc. How do you think Republicans will manage that message in the weeks to come?
I think they just place the blame squarely on President Biden. They pivot to inflation. They pivot to the Federal Reserve and interest rate hikes. They talk about the riskiness of the high-tech sector, the concentration of this bank. What I heard overnight from staff across the board, whether on Democratic or Republican circle sides, was a discussion of how this is a contained bank crisis that is explicitly in Silicon Valley, explicitly in high-tech sectors. It has no impact on, the heartland, the farming businesses or farming banks. And that's something that they wanted to see in order to get any kind of bipartisanship. And that was brought up in every conversation I had last night. This is considered in D.C. Very isolated and not really the problem of most of America is really the perspective.
The question I would have for them, if it is indeed that isolated and not a problem, why do you think they had to trigger the systemic risk exception?
My personal answer is that there was no chance of congressional intervention. There was no chance of any oversight. The reason that you have those classifications for systemic risk is explicitly because when you need to have control of those federal regulators and you cannot rely on Congress, they need to have the authority to act. And that law has been changed several times. We increased it again in 2008. To deal with the financial crisis and hike the insurance guarantees. And they have the authority to act on their own with the Fed, the Treasury, the FDIC, and the president. And that's exactly what they did because that was the only option they had available to them. There's no scenario where we get congressional action here for this year, in my opinion.
Is there a concern about moral hazard in the meantime, Henrietta, given that we've basically just told every bank in this country that your depositors will be made whole?
I think there's definitely the concern about moral hazard, and you'll probably hear a lot about that from lawmakers. One thing I'd like to just put in the easer for you and your watchers is that the Fed's discount window openness, the potential easing there is something to really monitor. I was in the Senate during the 2008 TARP votes, and one of the amendments we saw repeatedly was that there were going to be efforts to open the discount window so that you can access the information about who was going to be accessing the Fed's discount window. I would say prepare for that, at least an amendment, a headline risk, and you would see that come up maybe in whatever bill passes next. Could be as late as September with the debt ceiling vote, but that could theoretically be in June, and they'll start working on it probably with the budget in April. So be mindful as you get into that moral hazard question that opening the Fed's discount window so you can really access all that information is something that we've seen members, specifically Senator Rand Paul of Kentucky, offer in the past.
Accessing some of these Fed facilities, Henrietta, sometimes comes with some negative connotations, a stigma perhaps. How do they avoid that?
They don't. They're not even trying to avoid that. They don't really concern themselves with it, quite frankly. When those votes happen, and this is just my muscle memory recalling, those amendment votes come up really fast, and a lot of members are not familiar with exact details of what the Fed's discount window includes. It's a risk of politics and things escalating rapidly. You got to rely on leadership in the banking committees to make sure that that amendment doesn't pass.
What a crazy situation. Just this idea that they're all going to go away. Henrietta Trace of Vader Partners, thank you very much. Let's get straight to the price action for you, about 5 minutes away from the opening bout. This is the move in equities. We're down 8 or 9/10% on the S&P 500. And here is the monster move in the bond market. We are down 50 basis points on a session, there and thereabouts at the front end of the curve to 4.09%. That is about a 100 basis point move from the highs of Wednesday. That's not even 3 sessions. That's Thursday, Friday, and a little piece of Monday morning. On a 10-year yield, we're down by 23 basis points. And the curve's a bit steeper because of this. The curve is steepening by, let's call it 28 points right now, 28 basis points. But that curve steepening is being led by the front end. That's called a bull steepener. Now, bull steepeners typically develop this aggressively when things start to hit the fan. And I think it's fair to say that things are hitting the fan just a little bit. Coming up, the financials under pressure, even as regulators step in. That conversation up next with Ken Leon of CFRA and Academy's Peter Cheer weighing in too. All of that just moments away.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg.
This week has all the ingredients to be a long decade. Equity futures right now, negative 1.2% on the S&P and the Nasdaq. We're down 0.8%. These losses following the biggest weekly loss of the year so far on both the S&P and on the Nasdaq. And the Russell, heavily weighted to financials, struggling. There's the opening bell. Switch at the board and get to the bond market. Monster move. Those numbers are not wrong. We're down 22 basis points on a 10-year in America, 347.91. We're down a lot more than that at the front end of the curve on a 2-year this morning, down 45, make it 46 basis points lower, 4.12%. In the FX market, who knows what to do with this? We're repricing the Fed. We're also repricing the ECB. Euro dollar back to 107. We're positive there about 0.6%, and crude tanking. We're down more than 4% on WTI, 73.49. 30 seconds into this, here's the price action for you on the S&P. We open lower by a little more than 1%. On the Nasdaq, we're down about 0.9%. One sector to watch at the open this morning. It's the banks under pressure. Even after regulators swooped in to reassure depositors, the KBW Bank Index, worst week last week since March of 2020. Kelly Lyons back with us with more. Hey, Kaylee.
Yeah, worst week since 2020 last week, John, and this week is not starting out on a better note, despite the fact that depositors of both Silicon Valley Bank and Signature Bank are going to be made whole, and the Fed has announced this new bank term lending facility that is going to lend to banks at extremely favorable rates. That is not helping the regional banks this morning. Clearly, there is still fear out there about this spreading elsewhere. Just take a look at the shares of First Republic, down 65% here at the opening bell. This is on top of a 33% loss last week. A week ago, this was $122 stock. This morning, it is trading at $28 a share. That is how brutal this wipeout has been, John. And it's elsewhere in the regional banks as well. PacWest, Western Alliance, Zions, they're all down substantially in the first few minutes of trading here. Western Alliance down 70% with about a minute and a half into the trading session. We will see if these losses hold throughout the day. And it's bleeding through to some of those larger banks as well. The conversation we were having on Friday is these are diversified financials. They don't have as much risk. They don't have as much concentrated exposure, so they were relatively more resilient, but that is not the case this morning. Really, all of the banks are lower. Right now, Citigroup, Bank of America, Wells Fargo, all down in the ballpark of between 4 and 5%. JP Morgan, the relative outperformer here, but still down the better part of 2% early in the session. And of course, we have seen the banks under pressure for some time now, John, but it is the regionals that have been lagging over the course of the last year. Again, the concern here being that they are more exposed to the Fed's rate hiking cycle, and it's raising questions this morning about how much further further the Fed realistically can go when you are seeing this kind of pain in the regional banking sector, John.
Those names getting absolutely battered. Kelly Lyons, thanks for that. A lot of analysts weighing in on the situation. We spoke to Jared Cassidy of RBC. He published this. He wrote the following: though we recognize we are not out of the woods, there is a light shining through that will lead us out. This sounds promising. We expect there will be opportunities over the near term to buy banks as the market realizes the actions announced yesterday will limit and prevent future bank runs. That last line. Can we go back to that board with all the banks on it and just look at that last line? Jared Cassidy of RBC believes at some point this market will realize the actions announced yesterday will limit and prevent future bank runs. And we still look like this morning. First Republic down 65%, PacWest down 36%, Western Alliance down 74%. CFRA's Ken Leon has this to say this morning: the fallout of this idiosyncratic episode is higher perceived risk in the financial system and worries about contagion that we do not see ahead. The larger banks are likely to gain market share from smaller banks in the current environment. Ken, I'm pleased to say, joined us right now. Ken, can we just start with the market action this morning? You and I have got a lot to talk about, but what do you make of these moves in the early part of the session?
So there's investor worries really on the depositor side to see if there's going to be an exit out of some of the smaller mid-sized banks. Larger banks are fortress balance sheets. That's the deposit side. The other side is really what triggered this was really their debt investments in securities like mortgage-backed securities held to maturity. If we had any change from the Fed that say perhaps clean it up in 1 year, that becomes a risk at large for the industry. We don't see that, but that's what really unwinds in this kind of market, is trying to create confidence. I think the president did that for the general economy, but as we look at equities here, there's still all the stirrings as it relates to what is here. Now, what's different than 2008 is these are transparent assets. They're all in the 10K, and it's just a question of going through each of these banks. Obviously, the ones that had concentration in deposits got hurt quickly. First Republic today, especially with the Fed and JP Morgan coming in for $70 billion, but it hasn't helped. So obviously, the equity markets are very worried.
I mentioned PacWest. It's been halted for volatility, dropped 41% to the lowest on record. These are some monster moves. Ken, there were two real announcements from yesterday. One conclusion that ultimately they're going to move to fully protect all depositors. So that's one. Two, if these banks elsewhere, not the ones that failed, but the banks elsewhere, if they've struggled to manage effectively their interest rate risk and they've got all these securities underwater, they can now post them as collateral at the Federal Reserve for this funding, this facility, at par. Now, Ken, do you think those two moves are sufficient to prevent there being another Silicon Valley bank, anything that looks like that in the coming days?
Absolutely not. And I think what you're going to see, and visibility, is going to be Michael Barr, the vice chair at the Fed for supervision. And you're going to see a legion of regulators like we saw in 2008 sit at banks. It used to be greater than 250 billion, too big to fail. I think you're going to go down to maybe even $50 billion of assets where the regulators, and they should have been there as the firefighters, but they weren't there. By Friday, when you have the FDIC, it's like the police coming in. So you're going to see very strong regulation, not only on capital, but also liquidity, stress risk, and also credit risk. These are going to have impacts on the economy. And the other thing on the monetary side is that we haven't talked about this in the last few days. The Fed was supposed to reduce its balance sheet of $2.3 trillion by $95 billion, with $35 billion for MBS and $60 for Treasury. That's probably not going to happen right now. So, the monetary will focus, the Fed will do what it needs to do there on inflation, but you got to watch the supervisory side, and that's led by Michael Barr, who was one of the architects for Dodd-Frank back in 2011.
These moves are huge. So PacWest halted for volatility. That dropped 41%, the lowest on record. First Republic now paused due to volatility. When I say volatility, we're talking about these banks getting absolutely hammered. Big downside move. Schwab dropping 19%, pause for volatility, Regions Financial Corp. I can just keep going through name after name after name after name. Ken, it's not just those that are lower this morning, also some of the big SIBs as well. Ken, can you talk to me about the valuation, the line that you would draw between the difficulties these lenders are having and what might not be happening elsewhere with the big institutions on Wall Street?
Well, first, of course, as an opportunity to buy stocks that have sold off is if they're trading near book value or below. That's probably true for many banks today. When you look at the fundamentals and the issues we have today, certainly large is safer. And certainly, I think there's going to be a flow more not only to the 6 largest banks, and most of them don't have exposure to unrealized loss on mortgage-backed securities. Just JP Morgan and Bank of America, and we're fine there. But the PNCs and some of the larger banks are going to be fine. It's really what's in the weeds for some of these smaller banks, and they're going to get the headline news. But right now, the institutional money is saying, we need to move on the sidelines and try to figure this out.
Ken, just quickly on net interest margins for some of those big banks, there was a fear they might have to start putting interest rates up for the deposit base. Given that you think so many of these deposits will flee to them just purely for safety, that's your view, Ken, ultimately, where does that leave NIMS?
NIMS is going to narrow, and that means, in terms of, where net interest income is 50, 60% of your total net revenue, it's going to slow down. So it's definitely a concern.
For the big banks as well, Ken, you think they'll have to put deposit rates up too?
Probably not, because they're so diversified. They have a high percentage of just consumer deposits. Many of them are, you also look at non-interest bearing versus interest bearing. You add these all up, it's called a deposit beta, and they're going to be okay. It's just, you just don't have this great bull scenario for banks because of rising rates. That's off the table. And to your point about NIM or net interest margins.
Ken, just a final one from me, just to put a bow on this. Are you saying you expect there to be another bank failure this week?
I'm not going to go there. That is a sensitive issue. But I think everyone who covers this industry is going, it's all in the 10Ks. And that's what we do at CFRA. We look at that. We put out quarterlies on delinquencies and everything else. On the credit side, we're watching areas like the credit card, but it's just beginning.
Yeah.
But it's all there, Jonathan, and I think this all gets flushed out today and tomorrow.
Ken, that's a hugely responsible response to that question. Thank you for that, sir. Ken Leon there of CFRA. Equities more broadly on the S&P, about 10 minutes in, we're lower by 1.25% on the S&P. Katie Lyons down in Washington. Katie, these are some big moves on some single names.
Yeah, they're massive moves. I mean, the KBW Bank Index as a whole right now is down 12%, and we have a lot of names, specifically some of those regional banks now halted for volatility, including First Republic, which at the time of the halt was down 65% intraday, and again, that follows a 33% loss on the week last week. Western Alliance also halted, down 76% at that point. Regions Financial halted at a 20% loss, and even Schwab now down about 19%. It too has been halted for volatility. That just goes to show you there is some kind of puke happening within investors for these banks, John, because remember, yes, depositors of Signature and Silicon Valley Bank are being made whole. Shareholders are not. And whether or not you think that is warranted from a policy perspective, that may mean that people just do not want to be left holding the bag here. So you are seeing some very real pressure in the regional financials. And as I mentioned, it is bleeding through to those diversified financials, the big guys as well. Bank of America right now, for example, down 7%. It does not appear at this point, John, that the market is buying what regulators did over the weekend as being enough. Not that facility from the Federal Reserve, and again, not the fact that depositors in these banks that have already failed are being made whole. There still seems to be a great deal of concern present right now in equity markets, John.
Kelly, thanks for that. Kelly Lyons, stay close down in Washington, D.C. With us now is Peter Cheer of Academy. Peter, I want to come straight to you on some of these moves. Either you believe that the moves yesterday from authorities, and welcome to the show, by the way, Pete, what a time for it. Either the moves yesterday evening weren't sufficient, or this is a monster buying opportunity in some of these banks. Which one is it, Pete?
So I think it's going to be a buying opportunity. I started buying Friday, obviously too early. I do think we're going to see more and more from the Fed. Having said that, it's not surprising. They didn't quite do enough this weekend, and also the complete narrative has changed. At this point, the only thing everyone's thinking about, and I think partly rightfully so, is unrealized bond losses, right? Nothing else matters. Everyone's got their attention on unrealized bond losses. So anyone with accrual accounting, whether it's banks or financial institutions in general, are going to come under severe scrutiny. And the lending program, while interesting, doesn't do a lot of that. To me, it doesn't fix right. It's if you had $100 of deposit and you need to sell bonds before that are worth 90 cents on the dollar, okay, you had to monetize that 10-cent loss. Well, now you get to park at the Fed, borrow 100, but you haven't fixed that loss. So I think that's going to be the thing that solves this market, is starting to get to a sense of how big these unrealized losses are and how you get around that.
So, Pete, you said they need to do more. Can you tell me what that more actually is?
Well, I think one thing is we really should have pushed harder to get some sort of private solution for SVB, right? Something where someone comes and buys it. We see something done other than just this guarantee and this vague word about we're not protecting the debt holders or the equity holders. So I think Haley was exactly right when she just mentioned that people are going to sell equity in these other banks because the equity has been unprotected. I think we need to figure out, how do we get some of these companies merged? How do we get some of them bought? How do we start thinking them as ongoing concerns again and not just a bunch of bonds on a balance sheet?
Pete, I want you to be really specific about why you think these single names are down so hard this morning. There will be a group of people sitting at home who ask themselves the question over the weekend, do I need to open a new bank account Monday morning? There will be others that saw the solution yesterday evening here in the United States as effective enough to tell people in this country, your deposits in your financial institution are safe, you will be made whole. And Pete, then we wake up this morning and we see this, the KBW Bank Index down 13%, and name after name halted for volatility because ultimately they're crashing in the early part of this session. Pete, what's driving that ultimately?
So I think last week it was a depositor story, right? It was worried about depositors fleeing, depositors not getting their money. The Fed fixed that to a large degree, but
the buying opportunity for some of these banks. Pete, which banks? Where'd you find them?
So I'm going to go in the index. I'm going to go in the mid-market, middle-level index. I'm trying to look for the larger ones. Again, I think SVB in particular, it had massive amounts of deposit growth. So it tripled its balance sheet right when yields were the lowest. A lot of other mid-sized banks only saw marginal growth. I think they've managed their balance sheet better. Again, it's almost like some people skip the class of finance where they talked about the S&L crisis, right? Which was a bunch of banks and savings and loans getting in trouble for owning long-dated treasuries, no hedge. So why they did that, I don't know. So I think there's a lot of better managed people. They will get this sorted out. People will return to that, and that's where the equity growth is going to come.
Pete, just a final one from me then. If that's the call on the single names, the banks, what's the call on this bond market move this morning? Down 50 basis points at the front end, pricing out hikes, pricing in cuts, not just here, but at the ECB as well. What's your response to that?
So I think it's largely right. I think the Fed has to be off the table for now, right? I think they pushed on rates until something cracked. Well, guess what? Something cracked. So now's a good time. Whoa, all these lag effects we've been talking about that everyone's been poo-pooing, well, here's a lag effect, right? This is an obvious lag effect. It's time to push back. And I would not be surprised to see talk about large-scale asset purchases, which I think is the preferred term at the Fed now for QE. So to see QT stop would not be surprising, and maybe something to support the market. I think we're back in crisis mode. And remember, to me, bank runs are way, 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 way more important than inflation. So that's what they've got to be arresting. And it's not just here, right? Europe has the same problems. That's what started last night's, we started futures went very high on the announcement, and then Europe started selling off as everyone realized every European bank is sitting on these same unrealized bond losses. So that's going to be the focus. Today's rally helps on that, but it's not going to be anywhere near enough.
They've been getting hammered this morning, that's for sure. Pete, thank you, sir. As always, Peter Cheer there of Academy. Broader market looks like this. 17 minutes in, the S&P down more than 1%, the Nasdaq down 0.9%. Kelly Lines, you watched the early part of the session. Those banks got absolutely hammered.
And they're still getting hammered. We now have the likes of Western Alliance back open for trading after a volatility hot, and there has been no recovery in the shares, still down more than 76% on the day right now. And remember, we're only 17 minutes into the session. Schwab also is back open and trading. It remains down about 20%. And the halts are still in place for First Republic, which was down 66% at the time it was halted for volatility. And Regions Financial now back up and trading, and it is down still about 15%. These are incredibly massive moves, John, and they also are bleeding through to an area of the financials that we did not see the bleed through on Friday. That would be those big diversified banks. They too are coming under pressure this morning. Bank of America, Citi, Wells Fargo, all down in the ballpark of between 6 and 7%. The relative outperformer among the banks this morning is JP Morgan, but it too is down about 2.6%. Broadly, the KBW Bank Index at this point, John, down 12.5%. It is really just an absolute bloodbath. It does not seem that confidence in this sector has been restored by the regulatory moves over the weekend. As you were just discussing with Peter Cheer, it's a question of whether or not it was enough. And what the market seems to be saying today is no. At this point, it is not enough.
Equities more broadly, and Katie, thank you. Negative 0.75% on the S&P. I have to say, given the drama in the financial sector, and this is to do with weightings, I know, but the index level not really capturing that drama. The S&P 500 down 0.6%, and the Nasdaq now recovering. We're down just 0.25%. Tech at the epicenter of a lot of this. Ed Ludlow on the West Coast with more. Good morning to you, Ed.
Good morning, John. Yeah, look, the biggest concern in the near term is the real-time access to working capital. I've been speaking with the FDIC this morning, and in the case of Silicon Valley Bank, they are pledging normal operating hours. Here on the West Coast, that means 9 a.m. local, 12 Eastern, and a lot of venture capitalists and founders I'm speaking to are literally trying to get access to their money. It's one thing to get backstopped and have 100% of deposits insured by the federal government, but if you can't access it in real time, that's a real problem. When we look to the equity markets, a lot of those most exposed to Silicon Valley Bank in the tech sector, names like Roku, Roblox, actually seeing pretty significant declines early in this Monday session. Roku, as an example, has about $487 million, or a quarter of its cash on hand when it comes to Silicon Valley Bank. We're learning increasingly, according to sources, that the relationship between VCs, founders, and other tech companies and SVB was incredibly complex, and it was a big web that goes well beyond just having deposits. Many of these companies also use other services like loans or advisory services, and much of that, according to sources, was conditional, right? So if you took a loan with Silicon Valley Bank, you would get more favorable rates on the deposit side as well. That is now coming to the fore, and actually what we've learned over the weekend, John, I've had so many phone calls. Venture capital firms are not sort of flush with cash themselves. And so what they've had to do is plug gaps for their portfolio companies, needing them short. There's a lot more to run on this story.
Ed, thank you, mate. Appreciate the coverage and looking forward to the show a little bit later. Ed Ludlow there with Caroline Hyde on the Tech Show coming up later on this afternoon. Here's a story for you this morning. The equity market has truly been all over the place. The low, we were down 1.5% on equity futures, this is. The high, we were up by 1.9%. We've now got the cash equities trading in the last 20 minutes or so. So the S&P 500 is negative just 0.2%. But one consistent theme right the way through the last several hours or so is just this relentless bid at the front end of the curve. Down 48 basis points on a 2-year, 4.1% on a 10-year yield. We're down by about 20 basis points, 349. And the theme, whether it's the United States, Treasury market, Europe, Germany, the bond market, we're taking out rate hikes, we're pricing in rate cuts. Amy Wu Silverman of RBC had this to say. Despite the fact that owning downside meaningfully underperformed last year, investors are finally focused on tail risk in the market. There is definitely more room for far more volatility. I'm pleased to say that Amy Wu Silverman joins us right now. Amy, you said it repeatedly, and thanks for being with us. When things get messy, all correlations go to 1. So where'd you get that downside protection now?
Yeah, it's tough, right? You know, not to be a bearer of further bad news, but as we start hitting even lower levels in something like KRE, you're going to start getting these gamma dynamics that happen with it, which is going to exacerbate further downside. So look, if this is something we think continues, you're actually better off in these general indices like S&P, where the moves have been a little bit less muted, but the tails are actually starting to tick up substantially. People are really taking an interest because, you know, something that is more of an unknown has hit this market and is starting to price through.
Amy, you've said it repeatedly. Some of these strategies underperformed last year. Why do you see that changing this year?
Yeah, you know, the big difference between last year and this year is we did get that move down, we did get that drawdown, but it was very orderly. It was this orderly grinding path down. And this essentially has been the opposite, you know, not a technical term, but it's been just quite gappy. And when you come in to work and you have stocks that are down, you know, 70, 80%, that's what volatility likes. That's what reprices volatility higher. So, you know, those trades, those owning puts that didn't work out for you last year, you know, they're realizing far more this year, and you're going to get those payouts on those downside tails.
Have we gone, Amy, from saying things are looking resilient to things were looking complacent?
It's funny because even last week, as we spoke to investors, investors were bearish. But when we asked them, "Are you hedging?" They said no. Essentially, they had their money in high yielding cash. But even now, you can see that even if depositors are insured, that doesn't go for the equity, that doesn't go for bond losses. And remember, we were, John, at a place where tail protection was at 5-year lows coming into this all through the year. And that's going to change quickly as we get through those VIX levels, sub 20, that's where we were before. Now we're hitting 30.
That's the question I wanted to ask you, Amy. Just looking at the situation at the moment and through the bond market, I understand there's a massive bid this morning, but still 4% at the front end of the curve. Why wouldn't I just go and buy that, run away and hide and come back another day?
Yeah, that's a great question. And look, I think we're going to see a little bit of that, this, shoot first, ask questions later, get off sides. But essentially what happened is year to date, people really came back into the equity markets. So there was this kind of low participation heading into last year. People are back. And, what's the quickest way to get downside leverage? It's actually to go into options, which is why I think you see that downside skew moving and getting bid up.
Amy, can I just finish on the VIX? It's often called on Wall Street, and some people criticize the people who use this phrase, but it's called on Wall Street the fear gauge. How useful is it as that?
So, the VIX was claimed to be dead for a while this year because zero DTE, the zero data expiration trading, was kind of front and center. Look, when we have these sort of systemic problems coming from the banks, coming from these individual names, what have you, I think the VIX becomes more relevant. We're starting to see now that correlation, that inverse correlation is coming back, whereas before that inverse relation had broken down. And I think that continues because, we saw 50 Cent come back, the huge VIX call buyer, and we're kind of seeing large institutions step in and say, we really do need some downside protection here.
Amy, thanks for this morning. Looking forward to the coverage from you and the team over at RBC through the week. There's a lot to write about. Your equity market negative about 0.25% on the S&P, trying to stage a recovery here on the Nasdaq at the moment, down about 0.1%. Want to get you some sector price action with Abby in just a moment, but here's a check on the bond market. Yields in at the front end still by about 49 basis points. With more, here's Abby.
Hey, John. Well, it's pretty interesting because with all of this fallout from the Silicon Valley Bank collapse, we actually have the S&P 500 at this point well off of its low. So to Peter Cheer's point in terms of buying, we're seeing that, but it's in the defensive sectors, utilities, real estate, staples. Importantly, though, tech is almost even. Apple's up 1%, Microsoft, so it's going to be really interesting to see how this shakes out through the day, John.
Abby, thanks for that. This market story is just phenomenal to follow. Painful for a lot of you, I know. So let's work through the next couple of days. Here's the trading diary. Coming up still, CPI tomorrow morning. Yes, it's still a big deal for this Federal Reserve and others too. After that, we still need to get through PPI and retail sales on Wednesday. Then, on Thursday, the ECB was expected to go 50 basis points. Will they get a rate decision and a news conference with President Lagarde? We will take that in full on this program. That's the schedule so far. Then you'll hear from Treasury Secretary Janet Yellen appearing before the Senate Finance Committee. That's going to be must-watch later this week as well. And finally, round out the week with the UMich Consumer Sentiment Survey. Right now, Friday feels like a long time away. From New York City, thanks for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, Their product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla. But XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud, The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroid, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
The Fidelities and the Schwabs and the E-Trades of the world, they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory roles of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings. As well as described about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be in the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park, and a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well, and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
You need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. One, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while, and I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G, and it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology, and live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不
管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高。但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
里面有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. and they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows, and we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers, and it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaxi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually